There is a particular kind of quiet that appears just before markets fracture. It isn't the calm of stability or slow trends. It's the uneasy stillness that forms when too many participants sense, at the same time, that something foundational has shifted. No one wants to be the first to say it out loud. That hesitation creates a narrow gap, the space between awareness and action. That's exactly where silver sits today. If you understand how markets really move, you know this phase never lasts long. Pressure builds, compression increases, then it releases, suddenly. What makes this moment especially compelling is that the strain is no longer hidden. Silver has pushed beyond $75. That level isn't arbitrary. It marks a change in structure. This shift isn't buried in obscure filings or whispered among insiders. It's visible. Open interest has separated from available supply in a way that would raise alarms in almost any other market. Premiums are breaking apart across regions, as if the global pricing mechanism is fracturing in real time. Delivery queues are stretching, while exchange inventories continue to thin. These are not subtle clues, they are warnings. Yet warnings only matter if people pay attention. Right now, most aren't. Equities dominate headlines, crypto pulls focus, central banks manage expectations and narratives. Silver looks dull again, at least on the surface. That calm is misleading. Underneath, the physical market is grinding under stress not seen in years. To understand why, we need to abandon the standard financial narratives. Most commentary treats silver as if it's primarily a paper asset, something that reacts to interest rates, sentiment, and macro headlines. That's only half the story. Silver lives in two worlds at once. In one, it behaves like a monetary metal, a store of value, a hedge against currency erosion. In that realm, it competes with gold, bonds, and other defensive assets. Price discovery happens through futures, ETFs, and psychology. In the other world, silver is an industrial input. It gets consumed, permanently. It goes into solar panels mounted on rooftops, into electronics sealed inside devices, into medical equipment used once and discarded. In this world, pricing is dictated by production schedules, procurement contracts, and delivery deadlines. Necessity, not sentiment, dominates. These two worlds operate on entirely different clocks. Financial markets move fast. Industrial markets move slowly and deliberately. When both worlds align, everything works. Futures converge to spot. Premiums stay tight. Arbitrage keeps order. But when they diverge, when paper markets price abundance while physical users scramble for supply, tension builds. That tension doesn't resolve gently. It breaks. We've been watching that fracture form in slow motion. Over the past year and a half, deliverable exchange inventories have trended lower. Not perfectly, but clearly. At the same time, futures open interest has climbed. More claims, less metal. That's leverage, and leverage works beautifully until someone asks for delivery. This is where many misunderstand commodity markets. Unlike stocks, commodities require real settlement. Metal must exist. It must be verified, transported, insured, stored. And above all, the system depends on trust. When trust is high, paper claims function smoothly. Participants accept them as interchangeable with physical. That belief allows leverage to expand. But when trust erodes, even slightly, behavior changes instantly. Paper becomes insufficient. Physical possession becomes the priority. That's when the math fails. The system was never designed for everyone to take delivery. It assumes most trade paper while a small minority deal with physical metal. That's not a conspiracy, it's how futures markets work. Problems arise when paper claims overwhelm physical availability beyond defensible limits. At that point, the market stops functioning as a market and becomes a confidence exercise. And confidence exercises end abruptly. I want to be clear, no one can predict the exact moment this structure breaks. Anyone claiming precise timing is guessing. Markets can remain distorted far longer than logic suggests. But what is clear is this: the structure is unstable. The imbalance is growing, and pressure doesn't fade on its own. It accumulates. Now look at the physical market, because that's where reality asserts itself.
Physical silver premiums have remained elevated for months, even as prices rise. That's unusual. Normally, higher prices compress premiums. That isn't happening. In some regions, premiums are widening. Delivery times have lengthened. Products are backordered. Some aren't available at all. These aren't seasonal quirks. They're signs of strain.
But that appearance relies entirely on participants accepting paper settlement. The moment meaningful demand shifts toward physical delivery, the illusion collapses. Industrial demand is the key driver here, and it's not optional. Manufacturers don't buy silver because they feel optimistic. They buy it because they need it. Solar panels require silver paste. Electronics need silver contacts. Medical devices rely on its properties. These uses aren't easily substituted. That creates inelastic demand. When inelastic demand meets constrained supply, prices don't rise smoothly. They gap. They spike. They move faster than participants expect. We haven't seen that phase yet, but the conditions are forming. There's also a geopolitical layer that often gets ignored. Silver is strategic. Countries that control supply gain leverage. Countries dependent on imports carry risk. As global trade fragments, silver flows increasingly eastward, into industrial use and long-term stockpiles, and out of Western inventories. At some point, that imbalance becomes obvious. And when it does, it doesn't resolve gradually. It resolves when someone important can't source metal and has to explain why. So why hasn't this already broken? Because the system is still being managed. Large institutions use positioning, liquidity provision, and strategic trading to smooth volatility and control timing. This isn't sinister, it's how markets operate. But those mechanisms require resources, they require metal. And as physical availability tightens, management becomes harder. Eventually, the cost of control exceeds the benefit. We may be nearing that point. Another important factor is positioning. Silver has been ignored for years. It underperformed. It bored investors. That means positioning is light. There's no crowded trade to unwind. That matters because it leaves room for new buyers. When markets are underowned, rallies have fuel. Silver also carries a unique psychological profile. It's accessible. Retail participation amplifies moves. We've seen this before. When silver gains momentum, enthusiasm accelerates price action beyond fundamentals alone. We're seeing early signs of that dynamic again. None of this guarantees smooth upside. Pullbacks are possible. Volatility is inevitable. But the move above 75 confirms something structural is underway. Downside corrections wouldn't erase that reality. Physical tightness doesn't resolve in weeks. Meanwhile, upside remains substantial. Even now, silver remains historically undervalued relative to gold. Mean reversion alone suggests much higher levels are possible if conditions persist. This creates asymmetry, defined downside, significant upside. That's what opportunity looks like. Markets don't wait for certainty, they move. One day it consolidates, the next it gaps. By the time consensus forms, the easy positioning is gone. That's why recognizing structure matters more than perfect timing. Silver above 75 is uncomfortable. That discomfort is the signal. Markets reward early recognition, they punish hesitation. So watch behavior, not commentary. Watch premiums, delivery times, inventories. Watch whether price holds or accelerates. Because markets whisper before they shout. And by the time they're shouting, everyone already knows. The window is open now, between awareness and action. History suggests those windows close quickly. And when they do, they close with force. The question isn't complicated. Are you paying attention?